OD, Jacob here. Today we're looking at company 37, our generic stock screener, Amphastar Pharmaceuticals in the pharmaceuticals industry. Just about 2.1 billion market cap, 2.4 billion enterprise value. Looks like they develop, manufacture, market, and sell generic and proprietary injectable inhalation and intranasal products pretty much globally. Growth has been very impressive. You're probably looking at low double digit growth here, maybe about 12%, 15% CAGR over the last 10 years. And return on invested capital recently is in the low teens. And we're starting to get to some operating profit here. And so much so where your operating profit in 2023 is greater than their gross margin in 2014. That's crazy. That's very impressive. Good for them. Their balance sheet shows about 257 million in cash-like products with 590 million in debt, but before it was about 73 million. So it must have done a one-time acquisition. Okay, yep, 506 million acquisition, 526 million in debt. No surprise there. But the debt in relation to cash flow, I mean, recently you're looking at well over $100 million, and I think it's probably the safest thing to do is just maybe average the last 3 years. They're looking at about 80 million. It's 5 times their 3-year average free cash flow. So it is a good amount of debt that they went into, but we'll see if this acquisition really bumps up their free cash flow or whether it was just to get some revenue growth. Obviously, when a company makes acquisitions, you want them to be making efficient acquisitions that are going to be increasing margins, making the company more efficient, maybe buying a product that they'd usually have to go through a third party for, so they save there. And we'll see probably in a year or two whether that was a good acquisition or not. But they do have some reinvestment. They do have share repurchases, and that's pretty much the use of their free cash flow. So let's just get right into it. Let's see what we're doing for revenue growth. I mean, I could see 10% pretty confidently, 18 on the PE price to free cash flow based on a solid return on invested capital, and they are reinvesting a little bit, but they're also buying back shares, at least recently, which does inflate that number a little bit. So 18 is still a premium over the market. I feel good about that at the end of 7 years. And for averages, well, it's been making money, so let's do a little bit of a range here, maybe 18, 22%. And then buying back shares, they've done a little bit recently, offsetting stock-based compensation, about 20 million, and that's about 50% of their 3-year average free cash flow, 60%. So 20 million, yeah, about 1%. So let's say they buy back 1% of shares. Okay, so with these assumptions, we're saying that it just needs to drop 12% before you get the return we're looking for. Another one that's pretty close. Pharmaceuticals are interesting, though. Obviously, when you come out with a drug, it comes out and then it's preferred for a couple years. And then when it goes to generic, it loses, maybe 80% of the cost. So we'll see whether they just had a drug come out, which is why their profits, both their margins are very high, and whether that's able to sustain or not, how long their drugs in effect before it goes generic. So, I mean, for now though, looks like an interesting company. I probably will be doing more research on it shortly. If you enjoy the video, have a great rest of your day. Thank you.